And now I'm going to hand over to Natasha Lamb, who is a leading sustainable investor, but also the chair of the board of IEN's nonprofit home. And she's going to kick off our next panel.
Good morning. This just fell out. I'm standing up because I can only see part of the room over here. So good morning to you on this side, and good morning to you on that side. I'm so happy to be here this morning. I just flew in from Costa Rica last night, and I will say I usually hate the air conditioning at conferences, but this feels really good. It was 95 all week and very dry and dusty. My name is Natasha Lamb. I'm the co-founder and managing partner of Arjuna Capital. I'm also a principal at New Summit Investments, which works to create access to the private markets in impact through impact-themed fund of funds. And I'm also the chair of the Intentional Endowments Network. As you know, the Intentional Endowments Network is a peer learning network whose mission is to facilitate investment in a healthy, just, and sustainable economy. And we hope that this morning's discussion does just that. We are going to talk about climate change risk as a financial risk and how endowments can prepare for that. We're also going to talk about how, as a collective, endowments represent powerful agents of change. And I hope we can do that by focusing on practical solutions and a big tent approach that brings all in and inspires all to action. There are multiple approaches to sustainable investment, whether it's divestment or ESG, et cetera. And I often use a layer cake metaphor to describe them. I think this is probably the most feminine financial model you'll hear about, layer cake. But when I think about sustainable investing, there's 4 layers to the cake. One is the first layer is what are you not going to invest in? And so for many of us, that might be nuclear weapons or tobacco or could be fossil fuels. The next layer is in terms of what you are going to invest in, what's the profile of those companies? This is the ESG approach. What's their environmental, social, and governance profile? And it's really a best-in-class approach. The third layer of the cake is what are you going to invest in that creates the solutions that transition us to a more sustainable economy? And the fourth layer, which we talk about sometimes within this group, and I think it's a powerful one, is engagement. How do we engage with the companies and that we are invested in, and with the investment managers that we're invested in, to ask for more, to ask for more sustainable solutions. This has been an area that I've worked in extensively in terms of engagement. In 2014, I pressed ExxonMobil to write their first climate change report. I filed the first shareholder proposals asking for disclosure of methane leakage rates. And it is a way, as owners in the companies in which we invest, that we have the power to ask for more, that we have a voice, and that can also inspire action and has ripple effects, which I think are very powerful. So when we think about endowments as a collective, there is an opportunity to engage as well as invest, divest, and look through an ESG lens. So this morning, and I'm going to transition, and hopefully this microphone works, so tell me if it doesn't. Hello? Still working? This morning, I'm joined by Laurie, Patton, the president of Middlebury College, and David Provost here on the end, also at Middlebury, by my friend Bob Litterman, who's the founding partner at Kepos Capital and the ex-head of risk at Goldman Sachs, and Ben Harper, the head of sustainability at Zurich Insurance Group. But before I get into these, very hard, pressing questions for this panel, I'm going to ask a question of the audience. So please raise your hand if you think the education sector is leading in sustainable and impact investment. All right, we got one.
Whoa.
won't have you raise your hand if you think they're lagging. In the higher education sector, we see the acute challenge of shifting nearly $650 billion in investment assets into alignment with the colleges and universities' own missions and curriculum. And that really is what they're teaching their students. Students across colleges and universities in this country continue to urge fossil fuel divestment and climate-friendly investment policies for their endowments. But whether or not the campuses are addressing student concerns, that's not the only risk here. The financial risk of climate change threatens the financial viability of many assets in endowment portfolios. And the challenge here is that we're not moving fast enough. So that's maybe why we just got the one hand. Sustainable investing in the education sector grew only 6% in 2018. Now, to put that in context, insurance companies grew their sustainable investments that year 37%. Thank you, Ben. While public demand for that kind of investing went up 54%. So the good news is that as of 2018, and this data is a little stale, more than 80 educational institutions have convened official committees on investor responsibility compared to about 40 in 2016, so a doubling there. So there's some more work to be done, and that's why we're all here this morning. I'm going to start with the Middlebury team, with Laurie and David. Middlebury has taken a proactive approach on how to address climate risk in the endowment. But in 2012, when facing pressure from students, the board voted not to divest of fossil fuels. What changed in your approach and your thinking?
Great. Thank you, Natasha, and thanks so much, everyone, for being here. I've already had like 5 incredibly energizing conversations in the space of 20 minutes, so it's really wonderful. And I should also let folks know, talk about peer-to-peer education. David is my CFO and has really been one of the engineers behind our Energy 2028 plan. It's a 4-pronged plan. We are going to be energizing our climate curriculum to be almost completely experiential. We're going to be 25% reduction in our energy usage by 2028 in all of our buildings. We're going to be 100%, our campus will be 100% powered by renewables by 2028 through the use of a biodigester, a biomass plant, which we already have online, and the largest solar field in Vermont. I guess we're tied. So that's how we're moving to 100% renewables by 2028. And the final is the panel theme, which is divestment over 10 to 15 years from fossil fuels. You're absolutely right. In 2013, we decided, the previous administration and the board decided not to invest because our investment managers felt that it was too costly to ask, and they didn't have the technology then, to ask individual managers to go in and tag each thing that was related to fossil fuels. So we made a statement then. But what changed was, number one, the conversation on the board level. Many kids of trustees said to the trustees, hey, what are you doing? Which was a really wonderful moment. 2, in 2018, we had so many deeply credible scientific reports coming out, which made a really big difference. Do we teach science at Middlebury? Yes. Why are we ignoring scientific reports? Kind of straightforward, but again, these are the kinds of trustee-level conversations one needs to have as a president. And the third is, the students said to us, what are you doing, to Natasha's earlier point, to live up to your educational mission? We say that we educate students to lead creative, consequential lives and contribute to their communities and address the world's most challenging problems. We're not doing that right now as the oldest environmental studies program in the country. I felt deeply as a president that I was not being the best leader I could, given what our students wanted us to be. And so working with the board, I said, what is an endowment? An endowment is something that should not be used for political purposes, but yes, can it be used for human purposes? Yes. Climate change is no longer a political issue, it's a human issue. So let's change that frame. That's number one. And number two, I said, this is an intergenerational issue. Our students are saying, look, trustees, your generation handed us this. Now you have a responsibility to help us solve it. So it was really the students asking for the trustees' help that changed their minds. And the final thing is, when I lost it, this is a very funny story, which I will share briefly, and said, look, please don't pressure the trustees anymore. They're really moving on this. You should be writing them thank you notes and not pressuring them. And smart students, 2 days later, a huge bag of thank you notes appeared at the trustee door right before we were about to vote on the entire package. So
Now we know the key.
that's the key. Yeah. And I'll turn it over to David briefly for
Yeah,
that.
thank you, Laurie, and thank you, Natasha. As Laurie, as President Patton mentioned, I had arrived at Middlebury 3 years ago and had done considerable work around sustainability at a previous institution, but a very small endowment. So arriving at Middlebury with a $1.2 billion endowment, it is a major driver for the health of the institution. Very quickly, the students found me. We have a very well-organized student group called Divest Middlebury, and it's been around for 15 years. Bill McKibben is on our faculty, founder of 350.org, so is often coming to visit Laurie and I on our leadership role in this space. In sitting with the president, she said to me, I think it's important, as we had just had achieved carbon neutrality in 2016, that the board had the foresight back in 2006 to set that target. And the president challenged the faculty, staff, and students, what's after carbon neutrality and Energy 2028, the 4 pillars that Laurie just mentioned, shared was what the board actually approved last January. So we're 1 year into this 10-year journey. On the specific question of divestment, at the time, we took a snapshot of our fossil fuel holdings at the end of December 2018, and we will be issuing a report every year of the progress that we're making. And one of the questions that the students, at first, in a sheer activism manner, wanted to just shout down the board, yell and scream outside the boardroom. And it was through a series of conversations and working with the students, first around understanding how our investments work. We have a pooled fund. We are with 13 other foundations and colleges, and our endowment is managed by an outsourced CIO. So as Laurie mentioned, it was difficult back in 2012 to prevent us from being in fossil fuels. A change there and a significant investment made by Investor and a willingness to work with us allowed us to move on that journey forward. And we do not have the first year's results, 2019. The first step was to prevent any new money going in to private equity holdings. So in the first renewal of maturing tranches this past summer, Middlebury and any other investor client was allowed to opt out of direct investments into fossil fuels. And I can explain that a little later, but that's how the mechanism works. The work of the students that ultimately led to our board inviting the students to come in to share their generational story, aligning with the college's mission statement, is probably the most impactful piece that had and resulted in the students actually thanking the trustees for helping them deal with one of the world's most challenging problems, which was, in their view, climate change.
It's an amazing, amazing story to take all of those forces together. I know we've been talking about going across political lines and ideologies, and so much of this is about science and action. What do we do, and what do we do as a collective? So it's really inspiring to hear how you brought all of those different contingents together. Congratulations.
Yeah, I would just add, keep in mind the Middlebury Board of Trustees is probably about 50% investment bankers. So
I think that's typical.
I should caution where we were starting, and there was some very strong opinions, so to get multiple stakeholders to the table was...
Yeah, and for the educators amongst us, won't do it now because we want to hear from our other panelists, but I have a lot of tactics as well as strategies on how to talk to investment bankers as an educator in a persuasive way around this issue. Yeah.
Well, we don't want to leave our resident investment banker out, so we'll switch now to Bob. Bob, the fossil fuel industry has gone nowhere in the last decade, while the stock market has been on the longest bull run in history. You have long talked about the risk of stranded assets. And do you think that that process has begun?
Oh yes, we're well into the way of moving toward a low-carbon economy. Unfortunately, we don't have the right incentives in place, and that is a real problem. I think it's going to change soon. But to back up just a little bit, we addressed this about 7 years ago at the World Wildlife Fund, and we wanted to make sure that our investments were aligned with our mission. So many of the directors suggested divestment. And we had our consultant come in and look through our portfolio, and they said, well, you've got a little over 1% in stranded assets, which we defined as coal, tar sands, and oil exploration and production. And they said, there's one fund that if you divest, you'll be under 1%, and we think that's fine, you know. But if you want to get rid of the rest of it, well, you're going to have to get rid of some of your private equity, hedge funds, active equity managers. Going to require turning over something like 2/3 of your portfolio. It's going to cost you an arm and a leg, and it's just a tiny little bit. So why don't you ignore that? And we said, no, we're not going to ignore it. We want to align our portfolio. Let's come up with a better solution. They came up with something that was, I thought, very clever. They said, all right, here's what you can do. Leave your portfolio untouched, but sell the stranded assets through an overlay. What we called a stranded asset total return swap. And it was a very simple instrument. It's a derivative instrument. But basically, we enter into a contract with a counterparty. In this case, it was Deutsche Bank. And we pay them the total return on the stranded assets, and they paid us the total return on the S&P 500. Now, I often get asked, why would a counterparty do that, by the way? And the answer is very simple. They don't really hold that position. They just, in effect, execute it for us by selling the fossil fuels into the marketplace and so on. So it's part of a big derivatives book for them. They're not making the other side of the bet. But if you think of it from our perspective, that instrument is a very simple bet. It's a bet that stranded assets are going to underperform the market. And I thought, you know, that's probably a pretty good bet. I had no idea. We did this a little over 6 years ago, and the average underperformance has been in double digits. It's been over 100% return in this 6-year period. And by the way, I think it's only accelerating. So to answer your question, yeah, this revaluation of stranded assets has been going on. This year, it's up double digits already this year. In fact, today you see the market is down 2.5%. When I looked, stranded assets are down another 2% on top of that. So it's just been a very interesting thing to watch, and I think it's accelerating. But having said that, I do want to put it in perspective. Markets are forward-looking. So what's going on is investors are saying, you know what, this industry, fossil fuels, is not going to be able to make the profits going forward that we thought it was. What they're building in are expectations of carbon pricing. And where we are today is we don't have appropriate incentives to reduce emissions, and emissions are increasing. And, you know, I'm an economist, I'm a risk manager, we're not pricing the risk. It's a fundamental mistake, we have to fix it. We're not going to, you saw that chart earlier about bending the curve. That's a great chart, and we are going to bend the curve. But it's only going to start when we price emissions. And it is urgent, and I would just underscore the urgency here. When we put that swap on 6 years ago, had we priced fossil fuels then, we would be aiming for a peak temperature in 2080 or whenever it's going to happen that would be 0.2 of a degree below where it is today. That's how much ground we've given up. We can't get it back. If we wait another 6 years, it's another 0.2 of a degree. And those tenths of a degree are incredibly important. I read this IPCC report. I'm not a climate scientist, but it's pretty straightforward. It says at 1.5 degrees C, which is probably too late to hit. We're now, best case, if we price emissions, and when I say price emissions, at a high level, at a level that will make the difference, over $100 a ton is where we should be. If we did that today, we're probably aiming at 1.7 or 1.8. We won't do it today, but the IPCC points out we're already losing coral reefs. At 1.5 degrees, which it's too late, we will lose 70 to 90% of coral reefs. At 2 degrees, we're going to lose over 99% of coral reefs. We're basically going to kill the oceans, and that's what's at stake. So we're going to price emissions. By the way, I could talk about the politics and why I'm very optimistic. We're getting very close to a tipping point, but I'll stop for now.
Thank you very much, Bob. It was a good bet.
Oh, it was a good bet.
So hopefully others in the room can figure out how to make their own bets that work out in that in that direction. Ben, so earlier I spoke about the insurance industry and the growth of moving assets towards ESG, and I compared that with the higher education sector, and it's really, I mean, those numbers struck me because I think of any industry other than public demand, it's been the highest growth that we've seen. So there's no doubt in my mind that it's the insurance geeks, it's the number crunchers that are doing the math and they're moving their money. Can you share with us how Zurich is moving their investments and how a large, and that's one, so how are you moving your investments? And then also how you're thinking about this climate risk in terms of underwriting.
Sure. First off, I'm an engineer, so when you say geek, that's a term of endearment.
Oh, I only use it in that way.
Isn't the first time I've heard that, but first off, good morning, everybody, and thanks for having me here. I just want to take a step back real quick and just let people know, why an insurance company, really why the insurance sector is so involved with ESG, CSR, sustainability, Cribbit. One day I'm going to be the CAO of a company, Chief Acronym Officer. Maybe then I'll know what I'm talking about. First
Nobody
off,
else will.
Right. First off, in the U.S. alone, the property and casualty insurance market, our investment portfolio is $6.6 trillion. That's a big number. Just to put that in context, you could build 1,000 elementary schools a year with our portfolio. You could build a road from DC to LA, which probably isn't real climate friendly, but you could build a road every year with that money. So we're a significant player in the investment world. Secondly, we're in the business of underwriting risk. That's what we do. And we just simply can't ignore ESG for the reasons we're underwriting risk. When we underwrite risk, we're assuming shock for our clients. So we think of it as us providing economic resilience. We're insulating them from a lot of that shock, and it's our business to make them whole. So when we look at the three pillars of economic resilience, it's the ability to withstand a shock altogether, the ability to recover quickly, and the ability to minimize the impacts of that shock. And with the uncertainty that we're seeing today with climate and other related issues, other environmental issues, we simply knew that we had to integrate ESG into the way we do business. And also, when you step back and look at it, it was just the right thing to do. It really is. Now, I work for a European insurer, and I truly believe that the European markets have been a little bit ahead of the curve on this, but at the end of the day, it was truly just the right thing to do. I had some numbers here, but you know what? I won't go into some of the numbers. But so being proactive, you're asking about us reshaping our portfolio. We were the first insurer to sign the UN's the business ambition for a 1.5 degree pledge. And with that comes, a lot of responsibility and a lot of tough decisions. We had to look at reshaping our portfolio. What are we going to do in order to support the transition to a low-carbon society and meet the ambitious targets that we set for ourselves. And so we had to exit some difficult pieces of business. A lot of those we've touched on just here in the first few minutes. And we are worried about stranded assets too, and they kind of go hand in hand. So, we're aligning our portfolio, and that was very difficult. There were some very significant numbers, particularly in the energy space, and it impacted us to a fair extent. We also, on a very positive note, we looked at aligning our portfolio, and we looked at green bonds, and we're looking at very significantly at how these green bonds are constructed and whether or not they align with our interest. And we're making a significant increase in our purchases there. I don't know if I can go to the exact numbers, but when I say significant, it's a significant increase. And we kind of had to do that because we're looking at our investment portfolio. We're a very regulated industry, probably as regulated as any other institutional investor out there. And there used to be certain things that we would consider safe and things that we could invest in. And typically, if we could get T-bill plus 1%, we're doing pretty well on what we call our safe bets. And one of those has been traditionally bundled mortgages and the 30-year mortgage. It's been a fairly solid bet through the years. But we're looking more and more just at the physical risk associated with that. And there's just getting to be too much uncertainty. And as an example, with the 30-year mortgage, I think everybody here is probably aware that if you're within a 100-year floodplain, that you don't have to buy flood insurance. And that's great. Everybody says, well, there's only a 1 in a 100-year chance that I'm going to experience a flood. And that's incorrect. That's 1 in a 100 every year. So on a 30-year mortgage, you've got 30 chances out of 100 that you're going to have that there's going to be a flood event. And then you look at the numbers of default on homes after a significant flood event, and the default rates are around 45%. Wow, that's huge. So, you're looking at something that there's likely a 30% hit to the asset itself, and then a 45% default on that, and that's before we factor in climate change. The 100-year floodplain is not the same 100-year floodplain we're seeing anymore. It's just throw that out the door. So we're seeing so much uncertainty. And with that uncertainty, if we don't integrate things like ESG, CSR, when I mentioned CRIBIT, we call that, I know that may be a different acronym for some people, but it's right,
This is why.
yeah,
You know what these are? They're called
correct.
TUAs. Totally unnecessary acronym.
Right. It's corporate responsibility in business transactions. Now I got to remember. You know what? That's one I'll remember.
It's a really good one.
So it's corporate responsibility in business transactions. Are we doing the right thing? So we have to integrate these things. And then lastly, I'd like to point out too, I don't know if anybody took notice at the latest World Economic Forum. There's some significant things that came out of that forum. And I think the two most significant things were, one is that in their annual survey of 20,000 companies, the top five risks were all climate and environmental related. For the first time, the top 5 risks, and that's significant. Secondly, and really something that I found really hopeful is that industry is not waiting for government. They're not looking for regulations and mandates to make the change. Particularly the financial sector they're making these changes today because they look at the science and they see what's occurring and they know that we have to deal with uncertainty, and so they're moving forward regardless of regulation. To me, that's very inspiring.
And there's one last thing I'm hoping you can share, because it struck me when we spoke earlier, and I said you buried the lead, which is how much in assets you're moving from dedicated ESG this year. You're going from $2 billion.
Well, we've got some targets on us in this one. I can't say the specific numbers.
Okay, all right, I won't share it.
We're still working on our forward-looking statements, but it's going to be a significant increase in our portfolio.
Yes, wonderful. Thank you so much.
Sure.
I'm going to go back to the Middlebury team, and David, you mentioned that there's 13 other endowments that are, part of the outsourced CIO group that you're working with. Are they responding in a similar way? Has there been peer learning that's happened across, across colleges and universities?
Yeah, so great question. So in our pool of the 13 clients, half of us are colleges and universities, half foundations. And I should note that some of those foundations are in the southern part of the United States where oil and gas might have a much greater impact. So they wanted to create a solution that could meet any of their clients, and they have offered what they've built for us to any of their clients. Smith College, another elite liberal arts college in New England, has joined the process that Middlebury has. Where we're seeing the most interest from our students is helping other schools understand how we were able to achieve this. So I often hear from the students, would I mind talking to so-and-so at this institution to explain the story of Middlebury. It was mentioned before, this is a journey, right? And I often say if it wasn't for the work done in 2012 and 2013, I don't think President Patton would have been in a position to move this forward. We made a significant commitment back then to find ESG solutions that weren't in the portfolio. Investor went and found those, and we're now approaching close to 20% of our entire portfolio is in this space. Well on it, that journey was going on well in advance of the commitment to back out the fossil fuels. So yes, we're seeing significant interest in working with us, understanding and learning from us. Smith is doing quite a bit of work, one of their faculty members who's actually here in giving a presentation. He's trying to understand the impact of some of the larger endowed schools now making this choice and how it will have an impact on bringing the industry of higher ed, similar to what you were just saying about the insurance industry, and what that tipping point in the impact will be in the speeding up of this trend.
And I do hear a lot from presidents. When we first made the announcement last year, I just happened to be at a conference in New York on financial aid where I'd say 50 of the top university and colleges where they are committed to increasing financial aid. And the reception of the Middlebury announcement was mixed. Because a lot of presidents said, thanks, Laurie, now we're going to get a lot more pressure from our activists and from our, and so forth. And it was very interesting. I would say that the university presidents sort of started to talk about, well, there's the slippery slope argument. And my answer is, yeah, and we have a solution for that. We've thought about it. Here's how we're going to address it. We're going to address it issue by issue. And that's a real concern that we can proceed as way opens, on that. But the smaller colleges, the University of California system aside, which is fantastic, but what we wanted to do was say, okay, College of the Atlantic, some of the other folks who've divested are really small endowments and can be nimble in a different way. We were the next big thing, and we thought we're still a small college, but the Wellesleys, the Smiths, the Franklin Marshalls, et cetera, those are the folks who are now thinking differently. We wanted to be that kind of place. And then we hope Georgetown's, announcement made a difference. So I think what we wanted to do was say, this knockoff effect is going to have a different kind of ripple depending on where you are. When you're smaller, 1.2 billion is not small, but it's sort of medium size relative to the large universities. You are going to be able to be nimbler, and I've moved now to the language of ethical obligation. I didn't before. I started with risk in exactly the way these two have just been talking about in such an inspiring way, and that was persuasive to my board, then moved to ethical obligation. I think if you make that rhetorical move, it's persuasive.
Yeah, I think it's a yes and, right? Because for some people, it is that moral obligation, and I love how you describe it as an intergenerational obligation to address these issues. And then there is this issue of risk and another one of opportunity. And because this is a big tent, we all are going to hear, one of those things will appeal to us, us in one way, and another thing will appeal to us in another way. But having this big, broader conversation, I think, is very helpful.
That is creating interdependence between different forms of addressing climate change. That is the key, precisely. I had a board member at the end who sort of woke up, hadn't done the reading, woke up and said, I get it, I think it's all symbolic silliness, but I get it that you have a campus management problem. And I said, I'll take it. I'm not going to try and persuade you. I'm a pragmatist in the end.
Sure. All right, I'm going to shift back to you quickly, Ben. Because I want to talk about not just divestment, which I think has been a big topic this morning, because there's so much pressure from students to divest, and we're facing this climate crisis. But there are ways to engage with investment managers and to different ways to address ESG, and we need all of these solutions at the table. So, you get pressure from your institutional investors to be more sustainable through shareholder engagement. How can you influence corporate behavior, and does it work?
Well, first off, I can tell you the pressures definitely work on us. I mean, and in particular, again, being a European-based insurer, and we signed up for some commitments. A lot of the other large investors signed up for those same commitments. So they're turning to us. If they're going to invest in us, we better align with their interests as well. And thankfully, we're all on board with the same thing for the most part. But they have a huge impact. What has another impact is the rating agencies. As an insurer, you kind of live and die by your ratings. And just one hit, going from AA to single A or AA to AA minus, that's significant. That takes a huge market cap hit right away. And so, and we're having to report now, what are we doing in this space? And we think it's only going to accelerate. The rating agencies are getting more sophisticated every day, and we want to make certain that they understand our complete picture and know that we're trying to do the right thing. So there's great pressure on it. And as far as being able to create change, I think the biggest thing we can do, we always call it setting risk-based price signals, which is kind of a fancy way of saying, if you bring us an asset that we don't particularly like, we may still insure it, but you're not going to like the price. So, and it can get to a point where you can get an asset that's either stranded asset or an asset that we think in the near future is going to be near stranded that you just simply can't get coverage for. It may be location based. We look at some of the wildfire activity out in the West, and a lot of it's because people are moving into some of these wildland spaces that previously that we probably shouldn't be there to begin with, but we all like living in those areas. We like living on the coast. So we send risk-based price signals and say, okay, if you want to operate in this area, particularly in the business area, business interruption is a very, very big coverage of ours. If you want to operate here, this is the price. And I think that's been pretty powerful so far, with people recognizing that if they don't become more resilient, more sustainable, there's going to be certain, contractually, there's going to be things that we won't be able to offer them.
So there's both pressures to integrate ESG, to price appropriately, as yes. Bob has trained us all. So I'm going to shift to Bob for our last question. I think we have a couple more minutes. Hopefully this is an inspiring question. What are some opportunities to invest in climate solutions?
Sure. No, thanks for that question. I sometimes focus on stranded assets, which is simple, but really the right framing for this is we're going to move to a low-carbon economy, and that transition is going to happen very quickly. And so there are plenty of opportunities there on whether it's renewable energy or electric vehicles or, in almost every sector, there will be a revaluation of assets. And so even, by the way, within fossil fuels, it's not all fossil fuel companies are going to go down equally. It's expensive sources of fossil fuels. So if you have, because we are going to be burning fossil fuels, we're just not going to be burning nearly as much. So the way we think about that industry, and we do similar analysis in all the industries, is who are going to be the winners and who are going to be the losers when the price of oil, drops, because it's going to drop. Now, I would tell you one really nice opportunity are carbon allowances. You look at California, they have carbon allowances that are selling at about $17 a ton, which is way too low. They're now, I think, 25 euros or something more in Europe. And in California, they have a minimum price for the auctions, which is just below, I think it's 15 and a quarter or something. And these allowances the minimum price is going to increase at 5% real for the next, 10 years. So you've got a guarantee, basically, return there. I mean, there's political risk, but basically, we think that's a very good opportunity for investors. And just more generally, there's plenty of opportunities. I think the way I think about it is that most people don't recognize that this is not going to be a smooth transition. I guess because I come at it as an economist and as a risk manager, I see that right now the price is in the wrong direction. And when we decide we're going to price emissions, we're not going to, ease on the brakes. We're going to slam on the brakes. There is this element of time compression. We don't have time. When you're a risk manager, you realize that time is a scarce resource. And if you have enough time, you can solve any problem. We don't know how much time we have with respect to climate change. In fact, the reality is we should have done this, 20 years ago, and we wouldn't have a problem. But right now, it's 20 years too late. We are going to slam on the brakes, which is to say we're going to create globally a high incentive to reduce emissions. And so that's going to be a phase change in the economy. And now, as an investor, what you want to think about is what does that imply in every sector of the economy? You want to put your chips on those, places on the table. There's plenty of opportunities both on the long side and the short side.
Wonderful. Thank you so much. Please join me in thanking our panel of incredible leaders in this space. Wonderful. Well, thank you. And oh, we can?
Yes.
Oh, good.
I played a little catch up this morning. I thought this panel was at 11:40, and then George texted me in my room at 10 and said, "Are you ready to get mic'd up?" Awesome. So let's take some questions from the audience. We have one right over here to the left. I just saw that big red time's up sign in front of me.
Hi, I'm Craig Altimos with Divest Ed. And my question is for the Middlebury folks. I'm curious why you're waiting another 15 years to fully divest from fossil fuels, just given what we've heard about stranded assets and fossil fuel stocks, precipitously declining in value now and in the coming years. Do you really think it's still going to be a smart investment strategy in 2034 to be holding fossil fuel stocks?
We get that question a lot. I'm going to have David respond. We think we can get there a lot sooner, but this is what it means to manage a college and work with the Board of Trustees. As we said, we think this is the outer envelope. Our goal would be much sooner than that, and I'll let David say more.
So we had asked our outsourced CIO to schedule out all our current fossil fuel holdings in private equity and the public markets. The timeline of 15 years, if you just simply look at the timeline of those maturities without forcing a sale of investment, the longest one out there was 15 years. It represents less than a 0.1%. But we wanted to be transparent in saying if we do nothing else except adding no new money, this is the natural sequence. As Laurie mentioned, my expectation is we will see the majority of it go down fairly quickly because of the stranded asset issues that we're facing in the entire investment community. The thing that raises the most eyebrows is we are giving investor, our partner, the decision mechanism to divest in the public. We could have divested the day we said, look, we've hired you to manage our risk and manage our investment returns. So they have full control of that. I expect, given the environment that we're seeing, those will be sold off sooner. But the 15 years was simply the number of years, if you looked at the longest committed asset in private equity, of the timeline that we would need. We would love to be there by 2028, which aligns with the rest of our goals.
And I will say that the two really interesting moments of conversation, one was with the trustees and the other was with the students. The students wanted us to divest completely in 3 to 5 years from their dirty 200. And we said, we'll do you one better. We're going to do all fossil fuels and all, I should have mentioned earlier, fossil fuel related companies, so people who make pipelines and so on, for not just the dirty 200 in a longer timeline. And so it was kind of the back and forth of that conversation that was very intense, but did work. The second is when our resources board and investment committee on the board said, okay, we could do a third within 5 years of divestment. And I said, so, took a deep breath. The board had just told me that they really like it when I don't care what they think. So I was like, yay. So I took a deep breath and said, okay, so then 50 and 6 or 7 is possible. Anything stopping us? And the person said no. And I said, so 100 is therefore totally possible within, say, 10 years, and they said absolutely. They didn't want to say that, so I had to push them to say that, but as soon as I did, there was no going back, and that was also a real pivotal moment for me in relationship to the trustees and the board.
Good morning. Hi, I don't know if you could see us. Shirley Collado from Ithaca College, and I'm president there and a trustee at Vanderbilt. And this question is again for our Middlebury friends, for David and Laurie. Thank you for being so open about what it takes to move a college and a board when you're trying to do the right thing. And you know, as all of you have shared in your comments, this is really about shared responsibility and what we're ultimately prioritizing. And Laurie and David, you have mentioned kind of the space between, let's say, the Middleburys of the world when you think about your student population and a $1.2 billion endowment versus smaller colleges, right? But then there's a whole group of us, and I'm really proud of the work we're trying to do at IC with a very modest endowment and a population of about 6,000 students, mostly undergraduate. So there are a lot of us that are in the middle. And I don't mean that in terms of rankings. I mean that in terms of being more enrollment dependent. You know, even those of us who are pretty healthy and modest endowments, relatively healthy levels of debt and cash reserves, still being faced with the complicated questions of what does it really mean to share responsibility in this? And I'm wondering, and perhaps other panelists would answer as well, what would be your advice for those of us that sit really, and many of us, right in the middle, and we're trying to make some pretty bold and ambitious and urgent decisions right now, when we don't have all of the resources, let's say, that you've been able to work with, even though I know you have other realities too. But there's a big group there that's not the teeny tiny endowment groups versus the relatively large and elite spaces that you're describing.
Yeah, I love that question. I'll be brief, and I think these guys could say some really wonderful things. I have an algorithm that mostly works, which is that I believe you can address, but not solve, all problems with time, space, money, or relationship. And you just go through the 4, over and over again. And so we were able to do this at Middlebury through all 4, in a way. Space maybe less so, but time, money, and relationship. I would take that algorithm and think through what kinds of relationships you can build with ESG if you're not quite ready to take, if divestment is perceived as a risk, which is the change that these guys are really inspiring us not to do. But if ESG is seen as less of a risk, create deep relationships with ESG. One of the things I worry about with the move to divest, because of its symbolic power, is that we're going to ignore our ESG and build up, which is really, for many financial folks, ESG is more the driver than divestment is by a long shot, and I want to make sure I say that. So that would be the kind of thing that I'd be doing, is looking at a number of different alternatives to create data on the ground so that when you got to the bold move, it's not so bold anymore, it's just the natural next step. And I think that's a key thing. The other thing I said, I experienced is we were trying to get rid of a very big deficit. And so what I said to the board was, and this is related to the question of, we were not in great financial shape, and I said, just like you were going to be conservative, as a fiscal conservative myself, around your endowment. You wouldn't take a balloon payment out on your endowment right now. That would be really dumb, because we were so financially challenged. So no more would we want to take a balloon payment out on our environment. And that also helped them kind of see that we were trying to be fiscally conservative in that space. So I think that would be another way to do it. The other enrollment I would make is around, an argument I would make is around enrollments, that in fact, your work is going to increase enrollments, in this area.
I think that, I was just to say, I think it's a very wise statement. ESG, I believe, should be a very big tent concept, and fossil fuel divestment may be a natural derivative of doing the analysis and seeing which companies are managing those risks and opportunities. But it's really, if you take that ESG lens, it's really about risk mitigation more than anything else, which should appeal to really any investment professional.
That's exactly right.
Hi, my name is Eric Daraso. I'm with Omni Research Group. I wanted to ask the panel, how do you individually assess the impact of your investments, let's say for public equities, on communities of color, both domestically and internationally? Is there any review specifically, for instance, if you own a company that may be polluting, let's say a chemical alley in Louisiana, is there any real review of that? Do you have a full understanding of those impacts of your investment portfolio, whether it be public equities or private equity?
I can speak to that a bit. I think, again, it goes into that view, if you're looking at that layer of the cake of ESG as one layer. And then there's also that top kind of icing on the cake of engagement. How can you change companies? And I know in a previous company I worked with, we were actually engaging with the chemical companies in Louisiana and pressing them around cancer and all of the issues that were happening because of the dioxins that were being produced, et cetera. So there's two pieces to it. If you look at it through an ESG lens, how is a company managing not just their human capital and their diversity, but how are their products and services affecting different communities? So that's one lens. And then through engagement, how can you make sure that the companies you're invested in are acting as responsible actors?
Yeah, and for Middlebury, in our choice of investor, and we selected investor back in 2005, every few years there is an analysis done on their investing behaviors and strategies. And they have a basic philosophy and principle around investing that addresses some of the areas that you've mentioned. More recently and more specifically, I've been working with some of our alumni who are in this space, alumni of color, who are creating specific funds to help areas of the country to invest in specific spaces, as you described. And our process is to connect them with our outsourced CIO model. They have to go through the same analysis that all of our managers go through and understand that it's not just for Middlebury, it would be for all the investor clients. But we are seeing more and more of those funds being developed and created that we believe have significant opportunities that we would be interested in investing in.
And I so appreciate your question, and it reminds me that I wanted to say something earlier, which is that we have a campus where the question of climate justice is very alive, and questions of impact, globally, we are very globally oriented in our programs, and so there's a question of global south and climate justice, which is very, very real for our students. And that has pushed us to ask questions of investor in new ways. We have to translate those questions, although investor, I will say, meets with our students regularly, which is also kind of unusual, and at first I was very nervous about it, and then I started to chill. And so it's a nice tradition now that happens, but that push, particularly in the global question of companies that have disproportionate effects in the global south around energy use and climate risk is a new question for us. But I did want to say something else, which is we're both hampered as well as liberated by the fact that we have an investment manager that is managing a whole bunch of other endowments. It's constraining in that we can't make as many flexible moves, or when people come and talk to us, they say, hey, can you do this? And we'll say, talk to an investor. We have a really close relationship, and they've been amazing with us, and it has had a catalyzing effect. However, if you have your own endowment manager, and I should have mentioned this before, that's going to change things entirely. Then you are much more dependent on campus climate more broadly to figure out what your strategy is, and you're going to be talking to your chief investment officer in a different way. So I think to Shirley Kayada's point earlier, it really will make a difference, and you as a president are going to have to manage it much more intensely if in fact you're all in-house. And that's a really important thing to think about if you want to take those bold steps.
We have one last question in the back of the room.
Thank you so much. I'm sort of semi-representing European universities here and also some Asian ones, just to see your marvelous work, right, to foster the global program. It's a question for probably Laurie. Just looking at the records, I see that Middlebury also expanded the program in all its schools internationally. Some of Asia, some are Asian schools, probably of languages, etc. And you also have a very interesting institute in California, Monterey, when you took over the Monterey Institute of International Studies. Have you perceived, and what's the geographical impact on the investors? Have you perceived that they perhaps put some or attach some strings to investments done in those other campuses? Are you looking for investors in foreign countries? Or since you are a major actor in New England, probably that has conditioned a little bit your own program, which also links with your idea of global adapting globally, how that might work. Are there different markets there, or you put that together in the same Middlebury endowment?
Thank you for that. There's a lot of ways to answer that, and I'll start at the beginning. Our global footprint and our carbon footprint are the next big thing that we want to tackle. I just want to make sure, because a lot of people say, how can you be so global? So we are now about to inaugurate an internal carbon tax. We're still working on the financial model for that, but that will be a very real expense for us in the budget. So I wanted to mention that earlier, and this is something that our two folks here are going to be able to model differently and better each minute as we think about carbon risk. So that's the first thing. Second thing, our campus in Monterey, Energy 2028 is focused on our campus in Vermont, although our campus in Monterey has their own version of Energy 2028. The California climate environment is very different than the Vermont one, although both of them are states that have considered seceding from the Union at different times, so that's itself an energy independence motivator. So yes, we have a really interesting model there that will not involve, say, the biodigester. We can do things on a rural campus that an urban campus cannot, but they think that they could actually get to the 25% energy reduction perhaps earlier than the Vermont campus. So very exciting work there. Our partnerships, so part of our environmental commitment has been in the global area of partnerships. We are not interested in buildings. We've had actual partnerships with existing universities for over 50, almost 75 years now. One of the reasons I found Middlebury so attractive is I was skeptical of the model of building new campuses globally and saying that that's a global strategy. I felt it was much better to do long-term social capital partnerships, peer-to-peer learning, to use Natasha's phrase, which I can tell really motivates her work. So The catalyst effect there is where I think we could move. To answer your question very straightforwardly, we haven't moved there yet. We haven't said, hey, to the Sorbonne in Paris, can you do something like what we're doing? I think that's a fantastic idea. I love that idea. I would want to be careful that the relationship was maintained. And frankly, many of the partners we partner with can teach us way more than we could teach them. And so, but what we have done is create a fund called GIS, which is the Global Internship Initiative that is, most of our 37 sites abroad are now funded with internships on the environment and environmental change. So when our students are there, they will be contributing toward the environment. And we also, with our partners in Kunming, have a summer school in environmental leadership in China. So we're working mostly at the pedagogical level around that, and I know many, many other places are doing similar kinds of things. We are working with the Nature Conservancy in China, that's the people that help to fund our School of the Environment in China. We could do a lot more with the Nature Conservancy in China, and we hope to do that in the coming years. So, thanks, it's a great question.
Great. Well, thank you, everyone, for good questions, a good discussion this morning on risk, opportunity, intergenerational obligation, and a big tent approach. So thank you again.